My name is Prem Kumar Raju and I'm a student at Cardiff Metropolitan University studying MSc Accounting and Finance. Today I'll be presenting on the effects of the interest rate changes on bank profitability as a part of my research method assignment. I'll discuss about its background, significance, aim and objectives, and its literature review and literature gaps and methodology and expected outcomes. So let's get started with the presentation. The influence of interest rate changes is crucial for determining the bank's profitability. For example, net interest margins, loan profitability, and deposit costs. Bank profit through lending at a higher interest rates than they pay on deposits, and changes in interest rates leads to change in the profit structure. For instance, between 2022 and 2023, the US Federal Reserve boosted its interest rates from 0.25% to more than the 5% to check inflation, which resulted in changes in banks' lending activities and deposit strategies. Rising interest changes usually improves net interest margins, but lower demands for loans and worse credit risks. This study imagines the impact of interest rates interest rate fluctuations on bank profitability as such is essential to financial banks to gain insights on whether they can navigate through an economic landscape by keeping interest rate increase constant. Moving on to the next slide. Background. The environment of a bank is one in which monetary policy decisions are detected to it, and it can barely feel the impact of the control on it. When interest rates are raised by central banks, credit demands falls, but finance on loans becomes more. So profit increases. On the contrary, low interest rates fuel borrowing the narrow margins, as indicated by the research by the Bank for International Settlements. A 1% increase in the interest rates result in a 15 to 25% basic points rise in net interest margins, favoring banks in the short term. India Budget 2024, this is according to that. However, high interest rates cannot be sustained for a long time, which means loan defaults occurring in the US banking sector, where default rates of commercial loans were 5%. So, moving on to the next slide. So, here we're going to talk about research rationale and significance. The research presented here is based on the rationale and the sensitivity of the global financial sector to interest rates. It is required for the bank to be able to adapt to the changes in the monetary policy so that the banks remain sustained and profitable. In June 2022, the International Monetary Funds observed that volatility in the interest rates was one of the factors behind 10% drop in profitability of global banks. Notably, in emerging markets, financial institutions can take advantage of these negative effects if they can study the topic. Moreover, this research can be used by policymakers to devise both attractive and monetary policies for economy and to ensure sound bank performances. So moving on to the next slide. So here we're talking about the research aim and objectives. The research aims to analyze the impact of interest rate variation on banks' profitability and how banks deal with the risk in adopting their strategies. The specific objectives includes to investigate the impact of the changes in interest rates on net interest margins, return on assets, and overall profitability. To assess the influence of central bank policies on the performance of the banking sector. To investigation of risk related to interest rates on banks' grounds in the sense of liquidity and credit risks. To address how banks employ to preserve profitability under a volatile interest rates environment. So moving on to the next slide. Research questions. The following research questions has been developed. How do banks profit from the interest rates when fluctuation vary in terms of the net interest margins and the bank loan portfolio performances? And the second one is, what problem does the bank face when interest rates is fluctuating, like high credit risk, loan default, and the cost of funding? Third, what strategies are bank adopting to manage interest rate risk and still be profitable? Moving on to the next slide. Literature. At the literature highlighted, existing bank profitability and the interest rate changes are the significantly different. NIM is a source of revenue of banks and it is sustainable to changes in interest rates due to its impact on loan demand. credit risk and deposit cost. So first we're going to talk about the interest rate changes and the bank profitability. According to the research conducted by the Hack and Nichols in 2021, rising interest rates tend at high to increase bank profitability through enhanced NIMs. Yet too high prolonged rates could incur higher default risk, as seen during the US Federal Reserve's 2022 rate increases, thus increasing non-performing loans by 5%. So moving on to the next one, monetary policy and banking stability. The studies provide evidence that aggressiveness in monetary tightening imposes liquidity constraints and that banks were met with reduced credit demands after interest rates increases and overall lending declined by 3%. Under the volatile interest rates conditions, bank in emerging markets find it's hard to sustain stability. Moving on to the next slide. Interest rate risk and asset liability management. Assets and liability of banks should be balanced against risk associated with the fluctuations in the interest rates. According to Lubinska in 2021, such banks which utilize interest rate risk hedge strategies including but not limited to derivatives and swaps remains profitable. A liquidity crisis may occur as a consequences of mismanagement, as one witnessed in 2008 financial downturn. Next one, the interest rates and bank stock performances. Moving interest rates alter the investors' confidence in the banks and generate stocks market reactions. Cumming and Yoldes in 2022 found that the bank stock prices can go down as a result of sharp interest rates hikes because such a hike causes the fear of the reduced profitability for economics with low consumer lender growth. This correlation is stronger. So next, the theoretical frameworks. This research will explain how banks make a profit from lending differentiates using the net interest margins, which is NIM, model, and the efficient market theory, which is EMH, will be used to test the bank's contributions and adjusting to changes in interest rates. So next, conceptual framework. The bank profitability theories are integrated into study to assess how changes in interest rates affects different financial structures. So next one is the literature gap. Certain gaps remains in terms of banks' adaptations to the extended interest rates volatility in different economics. There is further exploration necessary regarding digital banking effects on interest rate sensitivity. For methodology, the secondary qualitative data will be collected from peer-reviewed journals and financial reports of central banks. This collected data will be the thematically analyzed to generate insights on how the profitability of the banks is determined by the interest rate changes. The research philosophy will be interactive because it makes provision for in-depth understanding for conceptual financial dynamics and not the numerical data alone. It will apply to the banking sector when looking banking sector responses to the changes in the interest rates, employing existing theories like the net interest margin model and the efficient market hypothesis. Furthermore, the research will make use of the disruptive research design to present systematically and interrupt the effects of interest rate changes. A deductive approach will be used to apply theories such as net interest margin model and the efficient market hypothesis to imagine banking sector response to financial stock positively to interest rate inflections. Bank will follow these dense, difficult concepts and they approach with the economic situations. And the expected outcomes are the bank's profitability is very sensitive to changes in interest rates through net interest margins, credit risk, and liquidity management. The expected findings would shed light on moderate rate hikes, which are beneficial for profitability, but too high hikes could cause loan defaults and lower lendings. Furthermore, the banks with adequate risk management strategies such as asset liability hedges will face less financial distress. The research will also point out the emerging role of digital banking in reducing interest rate sensitivity and ensuring profitability. And that's it. And these are the references. Thank you so much.